Hey everyone, Coach Investor back to another earnings video for today. In today's video, we're going to discuss Disney's earnings report. Today was a big day. Inflation came in lower than expected, so suddenly inflation does not exist anymore. Apparently, someone in the big White House said that in July there was no inflation. And so every stock suddenly went up like crazy. For example, Nvite, remember that company? Well, that company went up over 200% today. But I digress, let's focus on Disney today. So Disney beat across the board. Subscribers, earnings per share, revenue, you name it. So that's great. We're gonna have a look at all of that in just a bit. They also announced that they are going to, launch their Disney, the ad-supported tier at the end of the year. Now remember, we've talked about that in a Netflix video when we said that Disney and the Trade Desk actually reached an agreement. The Trade Desk also reported earnings one day ago. Stock was up 34% today because, the Trade Desk, unlike other ad tech companies, is just flawless. But again, let's focus on Disney here. So back in July, they said that Disney advertising transformation accelerates through expanded deal with the Trade Desk. The agreement will enable a first-of-its-kind integration between Disney's proprietary audience graph and the open-source identity framework, or Unified ID 2.0, within a secure environment. As a result, buyers will be able to discover more addressable, biddable inventory across the Disney portfolio, all validated by Disney's proprietary audience graph. And so again, this just gives us, the customer, more choice when it comes to pricing. This gives advertisers more choice when it comes to advertising. So this is great. This is a great win for the Trade Desk, and this is great for Disney. We've talked about Netflix and Microsoft deal. It's great for Netflix that they're going into the advertising side of the things in streaming. So all in all, good news there. Now, before I jump into the earnings report, if you want to support this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to full.com/couchinvestor and make sure to check out all the other links in the pinned comment, some of which might actually save you some money. Earnings report, Disney's earnings report. As always, I will say this. It's really a shame that this is the type of earnings report we get from a company called Walt Disney. It's just very, very old school. And by the way, just so you know, there is no way to contact investors relations via email. I've tried. So the CEO says here, Bob Chapek, we had an excellent quarter with our world-class creative and business teams powering outstanding performance at our domestic theme parks, big increases in live sports viewership, and significant subscriber growth at our streaming services. With 14.4 million Disney Plus subscribers added in the fiscal third quarter, we now have 221 million total subscriptions across our streaming offerings, which, by the way, means that they now have more subscribers than Netflix. He continues by saying that they continue to transform entertainment as they near their second century with compelling new storytelling across our many platforms and unique immersive physical experiences that exceed guest expectations, all of which are reflected in our strong operating results this quarter. Which I agree, year over year, this looked very, very good because last year, a lot of their parks were not operating fully, some closures from COVID here and there. Live sports was also not up to speed as it is today. So year over year, you will find those numbers extremely, extremely good. Now, I'm not gonna lie, those numbers are good. So revenue came in at $21.5 billion. That's up 26% year over year and beating estimates of just under 21 billion. Income from continuing operations before income taxes, that grew over 100%. Total segment operating income grew 50% to $3.56 billion. Net income from continuing operations, that grew 53%. Again, obviously because last year, more costs, less revenue coming in because some things were closed. So that's why you see those huge, huge increases year over year. Now, diluted earnings per share from continuing operations, that's up 54% to 77 cents. Diluted earnings per share excluding certain items, that's up 36% to $1.09. Free cash flow is down because, more costs, etc. More things are open, more investments. It's down 65% year over year. So now the different segments here. So Disney Media and Entertainment Distribution, that side only grew 11% year over year to $14.11 billion. But Disney Parks and Experiences and Product obviously grew the most, because again, I'll repeat myself, reopening of everything, that's up 70% year over year to $7.39 billion. And as for operating income, the first one, the Disney Media and Entertainment Distribution, that's actually down 32% to $1.38 billion. But again, Disney Parks, Experiences and Products, that's up over 100% to $2.18 billion. Now going even deeper in those two segments here, linear network, that's up just 3% year over year. Direct to consumer is up 19%. Content sales, licensing and others, that's up 26%. And then elimination of intra-segment revenue, that's just small things here, down 17%. Overall revenue for that segment is at $14.11 billion. And of course, operating income loss is the direct to consumer, that's over 100%. Linear network, that increased 13% to $2.46 billion. The explanation for that big increase in operating loss is due to a higher loss at Disney Plus, lower operating income at Hulu, and to a lesser extent, a higher loss at ESPN Plus. So let's have a look at all of these three segments here. So those are the paid subscribers. So Disney Plus domestically, so US and Canada, that increased 17% to 44.5 million. Internationally, excluding Hotstar, that grew 48% to 49.2. Remember, Disney is still not available in every big country around the world. During the summer, during last quarter, they did open up in a lot of countries. That's why you see a big increase here year over year. Now Disney Plus, excluding Disney Plus Hotstar, overall, that grew 32% to 93.6 million. Now Disney Plus plus Hotstar, that grew 30%. So totally just Disney Plus, not ESPN, Hulu, they reached 152.1 million. That's up 31%. Now again, those numbers look great, but we're going to have a look a bit later, well, just after this, at how monetizable those users actually are. Now ESPN Plus, that grew 53% year over year to 22.8, so big increase there, not surprising since sports is back. As for Hulu, that grew 8% across the board, SVOD, live TV plus SVOD, and then obviously the total one stays 8%, which totaled just over 221 million subscribers, which beat Netflix, which sits at 220.67. And now the average monthly revenue per paid subscriber. So domestically, US and Canada, that's down 5% year over year to only $6.27. Internationally, that's up 14% to $6.31. Disney Plus excluding Hotstar, that's up 3% to $6.29. Disney Plus and Hotstar is still basically nothing. It's up 54% year over year, yes, but it's just $1.20 because, well, pricing in those areas is extremely competitive there. So they have to keep it very low because, well, no pricing power in those areas. And so global Disney Plus, that just increased 5% to $4.35. ESPN Plus grew 2% to around the same number, $4.55. Hulu is where, well, obviously the money is at since advertising is big there. So Hulu SVOD only is down 2% to just under $13. But live TV plus SVOD is up 5% to $87.92. So you understand why they're going after that play of offering an ad-supported tier across the board, first in the United States, then internationally. I hope these numbers showed why, and I hope these numbers also showed you why Netflix has to do that as well. Now, Disney does not give us any guidance in the report. They'll probably give us some in the earnings call. If they do so, I will pin it in the comments below. Now with Disney, because it's such a strong brand, it's one of the strongest brands on the planet, right? One of the most loved ones as well, unless they go a bit the political way as they've been doing for the last couple of months. But right now in the high inflationary market world, let's say, spending more than $100 per person to go to a Disney park is probably not affordable for everyone. The same goes for the subscription. Obviously, right now, it's still fairly cheap, even though they did raise prices. It's still fairly cheap compared to Netflix, for example. So let's see who gets canceled first. But overall, with Disney, they're still not paying any dividend. Like I said in the last video, I do think that once they reach their goal by 2024, 2025, they will be paying dividends. Again, I'm still a holder of my shares that I bought a couple of years ago. Obviously, I would like to see dividends come back in the future, but right now I'm okay with them investing in Disney Plus, in innovating their parks, because like we've seen, it is working. Now, obviously, it's not such a high growth stocks like we've been talking on this channel, but to me, the growth is still there. Obviously, do share your thoughts down in the comments below. Do you own Disney stock? Do you plan on going to Disney World or Disneyland this summer? Let me know down in the comments below. And if you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. And I'll see you all in the next one. Bye bye.